Welcome to episode 49 of the Minds Capital podcast, the show devoted to the growing world of independent sponsorship and entrepreneurial private equity. I'm Will Smith, here with my partners in Minds Capital, Nicholas James and Max Lemus. Today's conversation is with Kevin Wong of Lang Partners. Kevin and Nicholas go back some years. Kevin was an investor in Nicholas's platform. I'll go to you first, Max. Was there anything about our conversation with Kevin that struck you?
Well, I think it's a theme that's come up before, which is that EQ, when you're thinking about investing in a sponsor, EQ is actually the differentiating characteristic that folks are looking for. IQ is really a commodity, as crazy as that sounds in this space. The financial modeling, the financial engineering, that's all table stakes. Everybody can do that. And I don't think that was the case, maybe 15, 20 years ago, but it is now. And you have AI that can help with, setting up these models and preparing slide decks. And so what's really important, as it turns out, is the sponsor's ability to be a leader and to get everybody rowing in the same direction for their platform company. It's not easy to do. And that's where the sponsors really shine. That's where the returns come from, is that consistent ability to lead a team, to hire, to put processes in place, set goals, meet goals, and do that over a long period of time. That's the hard part. And Kevin was very explicit in saying that that's what they're looking for in sponsors. Of course, they're a family office, and they are invested in, I think he said 27 or 28 different sponsor-led portfolios. So that's something that keeps coming up, and the world's evolving, and it's just so funny to hear that IQ is not a defining characteristic.
So Kevin, I should say, it's obviously he's a capital provider, and so while to date we've done almost all, not all, but almost all interviews with independent sponsors, we're now starting to bring on other players in the ecosystem. So Kevin's a good example of that. To your point, Max, around EQ, I liked his use of the word commercial. You'll recall he says one of the characteristics we look for in independent sponsors is that they're commercial. And I stumbled on it in the interview, and so I looked it up later. And I guess apparently it's used in the UK a lot to mean capable in a business sense, in a very concrete way in the market, really effective as someone who can create value, as opposed to a more academic, a more theoretical, spreadsheety type person who, on the point about IQ, may be swimming in it, but that doesn't necessarily translate to commercial outcome. And so this descriptor of somebody who is commercial tries to capture that. I had never heard the word used that way, so I was intrigued by it. There you go. Nicholas, you're a capital provider you know well in Kevin. What struck you about the conversation?
I've known Kevin for many years, and I think I met him at an Opus Connect conference way back in the day. I mean, we're looking at 8-9 years ago now. We kept in touch, we built a relationship, and through his current family office, they invested in my home services roll-up platform that we closed in 2020. And since then, he's been a capital provider of us, and he is really well connected in the ecosystem and super experienced as a capital provider to independent sponsors. And sitting in a family office, he's able to also contrast what investing in this asset class means compared to other asset classes. And I often talk about how the debt side of the independent sponsor capital ecosystem is quite mature with all the SBICs. The equity side, I think, lags behind it. It is rapidly getting more mature as well with the introduction of firms like ourselves at Minds Capital. But Kevin is truly one of those institutional investors who's been focused on investing equity in independent sponsors for quite a long time now. So he's quite nuanced in how he thinks about it and what he likes and doesn't like. And I think a lot of that shines through in this interview. At ServiceStar, my company, Kevin was a board observer. And my theory was always the more smart people we have around the table, the more beneficial it's going to be for Service-Star and our company. And that certainly was true. We put together a great group. We had a lot of fun. But I would say we had 2 or 3 observers in the room, and they added a lot of value over the years. And as part of the underwriting, nobody ever asks who else will be in the room or who's going to be an observer. But the truth is that everyone in the room has a voice, and that voice carries weight and has influence. And as we discuss in this interview, as a capital provider, there is almost equal value to being a capital observer as it is to being a board director. You don't have a vote, but the reality is that the vast majority of situations don't actually have a split vote. You'll rework the situation if there's not consensus in the room. And so I think Kevin rightly points that out and says that that model works for them as they work with now 28 platforms. It's scalable. It enables them to have access to all the information. It enables them to be part of the conversation. And then for the sponsor, it's really great because they get to have more people in the room than the very few people they have space for on the board. So at least for me, my experience was that I was fairly open-minded about inviting people into the boardroom. And so the more smart people we would have there, the more value we could generate around the table. And it was just fun to reflect on that and hear his perspectives on that as a repeat investor.
Well, before we turn to the interview with Kevin, a reminder that at Minds Capital, we invest equity into independent sponsor-led acquisitions. Our check size is $1 to $3 million per investment, and we average 1 commitment a month. So if you are a sponsor raising equity for a platform acquisition, submit your deal to us via our website, mindscapital.co. Or if you're interested in investing in Minds Capital as an LP, there's a pre-registration form also on our website for accredited investors. If you are an accredited investor, you can fill out that form to be kept in the loop on future raises. That is mindscapital.co. Okay, here is episode 49 of the Minds Capital podcast with Kevin Wong of Lang Partners. Enjoy. Welcome to the Minds Capital podcast, your connection to the growing world of independent sponsors and entrepreneurial private equity. We are your hosts, Will Smith and Nicholas James. Kevin Wong is the Chief Investment Officer at Lang Partners, a family office in Dallas. Kevin has orbited the lower middle market as a lender and investor for over a decade. He's led Lang to become one of the most prolific investors in the independent sponsor ecosystem, where they've invested in 27 sponsor platforms since 2020. Check sizes range from as little as $1 million to upwards of 20, with their standard being in the $5 to $7 million range. Lang Partners hosts the annual Lang Outing, an exclusive gathering of their independent sponsor partners. We here at Minds Capital actually know a number of sponsors that Kevin and Lang have invested in, including you yourself, Nicholas James, I believe. Kevin, you are in Nicholas's Service-Star deal, are you not?
That's right, we are. So we invested with Nicholas back in 2020 as we were launching our independent sponsor effort and really our family office. And we at Lang number our investments, 1 through, I think now we're at 28 or so. And Nicholas is LCAP 1. He was our first investment in June of 2020. So we've had the pleasure of being an investor in his deal, coming on 6 years now.
Well, I'm happy to share with you, Kevin, that a few hours ago, earlier this afternoon, we successfully exited. And I'm excited to tell you that here live. And a huge relief that we
Congratulations.
sold the company earlier today. So that just happened. The money just hit the bank account about 20 minutes ago.
Wow.
That's really exciting.
Yeah.
Nicholas, I knew there was something different about you, a certain glow there that I was noticing. That's really, really great. Congratulations to both of you, gentlemen.
Wow, it's wonderful news. Thank you for sharing it with us.
And thank you for having been such a fantastic partner for all these years. It's been a journey. We've had a lot of fun. It's been a great group, including you in the boardroom. And I'm thrilled that we were able to deliver a win today, and hopefully a good journey going forward for all the employees and partners we've had along the road as well.
Yeah, for sure. I mean, we are thankful to have you shepherd us along the way. I mean, it has not been up and to the right always. And thanks to your effort and the management team, we've had a successful outcome.
Kevin, when Nicholas approached you back in 2020, were you already contemplating a big move into the independent sponsor space? Given that here we have Nicholas as your first sponsor platform investment, maybe hearing the origin story of your independent sponsor strategy would be interesting.
Sure. When we launched the family office effort in 2020, investing in independent sponsors was a core tenet of our strategy. We had previously invested in all kinds of private equity funds, mainly on the larger side of the universe. And over the past 7 to 8 years or so, we have been pulling back that capital, returning it inside our four walls with the idea of redeploying that capital towards the lower end of the middle market and using principally independent sponsors as the deployment effort on the equity side of our portfolio. And so fast forward today, we have a great cast of GPs that we turn to time and time again to continue to expand our private equity allocation.
And what did you see in the independent sponsor asset class that you liked so much?
Like many family offices, our peer group, we have become wary of blind pools. We like making the investment decision ourselves, especially if you have made that investment in the ability to do the direct underwriting yourselves. And frankly, we think the return profiles are a little bit better, both on the MOIC side and from an IR perspective. And from our perspective, we like to find professionals who have been institutionally trained at firms like large consulting companies, premier investment banks, and great private equity firms. And we try to find folks who are early in their professional careers where they've had a great set of experiences, have developed wide and extensive networks, but have that entrepreneurial bent to themselves. And we catch them at a time where our capital can help launch their next chapter in the professional journey.
Why is it, Kevin, that you guys favor independent sponsors who have a solid track record, of course, but are maybe a little bit on the earlier side of their independent sponsor journey?
Well, I think that there's some set of uniqueness by targeting that subset of the independent sponsor world. I think we find alignment in finding those folks. A lot of the folks that we invest with remind us of ourselves, the principals that manage the capital today. They launched their own careers around that same age. And after being successful themselves, I think when they're on the other side of the table, they find a lot of commonality with the GPs we put our capital behind.
I wonder also if it's finding sponsors earlier in their career. It just means if that is a fruitful investment and partnership, if it just means that there's going to be more years to then enjoy it. There's that much longer of a runway that they can come back to you time and again with their subsequent deals.
It's true, Will. I mean, many of our sponsors today, we are on our second and even third investment with them. And all started with a meeting in our conference room back in 2020 or 2021. And we have the ability to mature in the industry together. And that second or third investment, the diligence process just gets all that simpler because we have that shared experience together, both the ups and downs that you see in any private investment.
Can you give us more on today, 5 years now into this journey by Lang, into this participation in this asset class, what the kind of ideal investment opportunity or typical investment opportunity looks like, other than we've talked about kind of where a sponsor might be in terms of age or where they are in their career, but flesh that out some.
Sure. We think of our private equity allocation into two buckets. The first bucket we think of as yield-bearing investments. So we aim through the investment by structure and the growth profile of the business to generate mid-teens cash-on-cash returns to our principals annually. And on the other side of the spectrum, we invest principally in buy and build strategies where we are hoping to grow both organically and inorganically through M&A. So in that case, we try to use the excess cash flow of the business plus a conservative amount of debt to grow the business through a pipeline of M&A acquisitions through our hold period. Nicholas's deal, ServiceStar, fell in that buy and build strategy. We started off with a very small business in the DFW Metroplex. Nicholas, I lost count. I think we're at 6 or 7 acquisitions before we called it quits and started thinking about professionalizing the business and preparing it for sale.
And what would you say? You said the mid-teens IRR is your goal when you buy a cash flow yielding business. What
right.
would be your goal for the buy and build investments that you do?
Yeah, for us, we try to compound in the mid-20s. So it ends up in about a 5, 6, or even 7-year hold period between a 2.5 to 3.5 times, maybe 4 times return on capital.
And so these, is there also an exit timeline difference between the cash deals or yield deals versus buy and build deals?
Yeah, we talk a lot about this internally. When we are a LP in a transaction, one of the advantages that we can bring to the table is our ability to hold. We are investing out of generational skipping trusts, which means that the capital that we invest today isn't really meant for the current stewards of it. It's meant for the next generation of the family. And what that really means is that it impacts the way we think about hold periods. We like to think that as long as the business is compounding appropriately and generating a decent return on capital, we'd like to hold it and to continue to see it grow. As we started to think about our strategy, we spoke to many private equity professionals, and the one constant thread that we saw is that they lamented that many of their best investments they sold too early, and they saw a opportunity to reinvest in that business years later and wish that they never sold to begin with. We're not operating in a fund construct that allows us to think differently and be with the business for a much longer period of time than most.
Say the phrase again, Kevin. Generational skipping. What was that?
Generation skipping trusts.
A generation skipping trust. Okay. And so that is where, as you said, it's not for the patriarch now, it's for his descendants, really,
right,
for the next generation. And I would have thought that most family offices are similar that way. Can you generalize there?
Once you see one family office, you only know of one. There are many different types of trust structures, and they're all designed for many different goals in mind.
Yeah. We had James Bohannon of Bellsburg on the podcast. He will air a couple episodes before this one. And he talked about how understanding the incentives and the structure of the family office is really important for the sponsors, and how often sponsors are maybe a little bit hesitant to ask you the prying questions to really, but they should, to really understand where your own motivations lie, not just time horizons, but any number of the factors that go into your decision-making process. Do you see the sponsors that you talk to sort of interviewing you in the way that James prescribes?
I think so, yes.
Oh, good.
As the industry matures, both the GPs and the LPs have a better understanding of the right questions to ask. And it's a two-way street. we're interviewing the GPs, and we very much expect them to be interviewing us as well, because it is a matchmaking exercise. You are in a relationship for many years together, and this is a repeat iteration game. You're with people on multiple occasions across many deals in your professional career.
A line that jumped out from our pre-call that you said, Kevin, was you're in the partnership game as much as the deal game, which I thought was a good distillation of the point you just made.
A little
That's
nugget
right.
on this. A little nugget on this actually is 3 or 4 years ago, I got a call from a guy called Jory Calkins. We had him actually on this podcast in one of our early episodes, and he called me and he asked me about Lang Partners because he was thinking about inviting you or including you on one of his deals. He ended up partnering with you, and I know you guys have formed a strong relationship by now, but that's an example there of a sponsor who diligences his LPs before accepting them into the cap table. I was very impressed. It made a very big impression on me getting an inbound from someone who's doing a reference call on someone about to give him capital.
Yeah. And now Jory's a close friend of Lang's, and we had the pleasure of now making our third investment with Jory.
In our conversation with Jory, his orientation is very much a long-term hold. That's his investment strategy.
Yeah.
And you talked about the two buckets at Lang as well, long-term versus buy and builds. What is the split there in your allocation? Is it 50-50 or something else?
It's not really well defined. We're very opportunistic, and we can move the goalposts as we see fit. I'll tell you that Jory's investments form the bastion of our yield-bearing section of our private equity investments. I mean, Jory is what we would coin the term commercial. It's the ability and intent to create more value than you capture. And that's a strong signal for us. And that is a character quality we try to find in our GPs. Commercial. It's an old Goldman saying. It connotes moneymakers.
How does the long-term hold, as Jory, for instance, does it, affect leverage and also affect or how much pressure is there to produce dividends when you're in one of those investments?
You go into it knowing that the dividends will vary, but by the cash flow nature of the business and the conservative leverage profile, you can see that there's quite ample room for distributable cash.
But when you're in board meetings and deals like that, is it a quarterly discussion on what's available to be paid out like it would be for a public company? Or is it totally at the discretion of the sponsor? How are the actual dynamics? And what if they go 2 or 4 quarters without paying dividends? What happens then to the people around the table? Does pressure build to rethink the strategic approach?
Look, so as a LP, you have to understand your role. You are a limited partner, and the general partner makes the decisions with respect to most strategic decisions in the business. Yes, you have an understanding from the onset of the deal, but things can change. Priorities can shift in the business. There is a fair amount of trust when you embark on a journey in one of these deals with the GP that, yes, those are the goals as stated when you shake hands and wire the capital, but it's at the discretion of the GP. Now, you can have influence on the ultimate decision, but it's on the GP.
Kevin, one question for you, a little adjacent to this one, is at ServiceStar, you were a board observer, and you were there for every single board meeting, and you voiced your opinion based on your experience, and you've been doing this for way more than a decade, right? What is the difference, in reality, in practice, between being a board director who has an actual vote and between being a board observer who doesn't have a vote but has a voice?
Over time, we've tended to gravitate towards being board observers rather than being directors. And once you start to amass a larger portfolio, your time can be consumed by board meetings. And we can exert, as we found over time, governance and control through the limited partnership agreement and consent rights, and be just as effective and protect and be a great steward of our capital through those rights rather than being on the board. And if you just have a great relationship with the GP, you can still exert influence through sidebar discussions, just informal ones. It doesn't have to be through a board. We found that institutional partners require the board seat because their LPs want it, and they need to provide that assurance to their investors. We're not set up that way.
No, I really like what you're saying there. And being a board observer, it gives you full access to all the information and all the data, all the narrative. But it's also more scalable in that you don't have to show up if you have a conflict, and you are not liable for the decision making. It is also true, right? And I think you agree that the vast majority of decisions in a boardroom seeks consensus. It's very rare that you have an actual vote that is a split vote. If there is not consensus, even among observers, you will rework this situation. Isn't that true?
Yeah, and if we're doing our job, we have already voiced our opinion before the board meeting actually occurs. And much of the work already is done before we sit down and actually make a vote.
Kevin, so hearing about the kind of profile of sponsor that you like, we've heard you invested in Nicholas and what you liked about Jory. What would you tell sponsors out there in terms of what you look for in them beyond quality of deal, beyond pedigree, character-wise?
Yeah. When we are assessing sponsors, we're trying to figure out character. We're trying to figure out alignment, competitive edge, things of that. But just really touch on character. We talked about trying to be commercial. We're trying to find folks who are trying to create more value than they take. So they think of investing in the independent sponsor community as a repeat game where you can be long-term greedy. We're also trying to find GPs who are in the investing game because they want to make money. So often we find GPs who are in this ecosystem because they get the satisfaction of being right. But their ego and our capital can get caught up in that goal. So we're looking for a high degree of IQ alongside a high degree of EQ as well.
That they want to be right. This is something that you are careful of. So you're saying you see people whose ego gets in the way of judgment, is what you're saying, or this is something you flag?
That's right. And I mean, Nicholas is a good example of that. We experienced in our Service-Star investment, he orchestrated carefully a motley cast of characters and got them together to march in unison on one goal, which is to create shareholder equity value, a larger business, a bigger business that all employees could be proud of. And that required a high amount of EQ. We saw the IQ in his professional background, but we didn't really fully know, and it was a guess that he could pull that off.
Is there any sort of screening that you do or kind of personality tests or anything? Maybe not for Nicholas, who was investment number one, but 5 years later, is this process at all more formalized?
Yeah. So over the years, our workflow has improved as we think about assessing the jockey as well as the horse. And now we do the typical background checks the reference checks, but we also incorporate a psychological background test. It really tries to understand the GP, how best we can work with them, how they act in stressful situations, and just allows us to be a better partner to the GP during the investment period and really, frankly, afterwards.
Kevin, on the EQ side, you had said to me that you think this is the most important trait of a successful independent sponsor. Can you elaborate a little bit more about the whole get everyone to march in the same direction? What do you mean by that? And why isn't financial engineering or negotiation skills more important?
I think to a large degree, financial engineering and the modeling skills has been commoditized. You can outsource that offshore, and now you can have ChatGPT create your own models. The true value creation in any of these deals is identifying talent on the management team, getting them on board, putting the right compensation packages that aligns them to the mission, and then communicating to them on a constant basis what that mission is, holding them accountable to the standards and letting them run. That requires strong communication skills and strong imagination and EQ. And that's not really typically taught at private equity firms. You need to learn that while you're doing it. And it's not something you can screen easily. It's a gut feeling.
I sometimes describe what you call EQ as sales, and that sales is something that's undertaught. But as an entrepreneur in any form or fashion, you have to persuade people. And in an independent sponsor's case, that's going to be the broker you meet, and then the business owner, and then the lender, and then the equity investors, and then the management team, and then the employees, and the customers, and the vendors. The list is long, and it's just a constant job of selling in, the narrative and the story. Are we talking about the same thing here?
The same thing. I would actually capture it as chief evangelist. You are the keeper of the mission, and your job is to get everyone on board on the bus and headed in the right direction with some velocity.
And so what happens when a sponsor is not so strong on this front? Well, how does that materialize? Does the deal even close?
Yeah, sometimes the deal does not close. And sometimes after the deal closes, you just have less than optimal outcomes. But if it is a strong business with a strong management team, you can still yield good outcomes. But the superior outcomes always come from strong GPs who can orchestrate an army to work together.
Nicholas, do you see yourself in the description you're hearing Kevin make here?
I definitely recognize it as a very important skill set for any entrepreneur. I have had my fair share of stakeholder management and alignment management from we found a deal and until we exited it here a few hours ago. And these have been some of the most challenging aspects along the road to keep all the vectors pointing in the same direction. Yeah, so I definitely agree and understand what he's saying. I guess my blind spot, Kevin, is more I did it my way, and I'm sure I could have been better at it and more effective. And had I known, in retrospect, everyone's motivations a little bit better, or been a better communicator, or kept everyone in the loop even more frequently throughout, maybe things would have been even better. So the blind spot for me, I suppose, is how you assess this on the front end and what a best-in-class EQ independent sponsor looks like.
It's so hard, right? We have our psychological tests that try to quantify that, but it's such a squishy thing to assess. And it's more of a gut feel. Hell, even David Swenson at Yale said that assessing GPs, particularly first-time GPs, is a art. There's no science to it, but the best returns come from those gut assessments.
How much of your assessments rely on because you guys know everyone, going to the McGuire Woods conference, a few are as well connected as you. And so how much do you rely on references and people that you know in common versus when you meet someone who's truly new to you? How do you go about assessing them?
Well, reference checks help a lot. And understanding their career trajectory, what they want to do with this pivot in their lives, and understanding their motivations is super helpful. And that just requires a lot of direct one-on-one conversations. We do a lot of background checks and try to understand how they've been successful in other periods in their career. And finally, it's how they negotiate the terms. That gives us a really full view on what motivates them and what drives them.
Anything else, Kevin, on the negative side of things that you watch out for? You've mentioned ego. You've mentioned, I guess, the lack of the good ones. So the lack of the ability to persuade, the ability to sell. Those the biggies, or are there others that sponsors should look in the mirror and ask themselves if they need to work on?
Gosh, well, for us, it's communication. We want to be one of the first calls when something bad happens so that we can help assess and figure out a solution. We don't like messaging. And that's part of the reason I think a lot of LPs want to be on the board. They want to have that primary information instead of having it packaged and then repackaged again before they see it. So the best GPs in our portfolio are the ones that over communicate. They tell us when something bad happens, and they also tell us their solution. It might not be the final solution, but it's their first assessment of how to move forward.
Right.
Is there a bias among GPs and independent sponsors to only report the good news?
Oh, sure, right. That I think that's inherent in human behavior. But that's what good partners do. You give them the good, the bad, and the ugly. And together as a team, you try to find a solution that works out for everyone.
Kevin, can you tell us about the annual Lang outing? What does that look like? Is it a fancy meal and nice wine, or something more?
Hopefully it's a little something more than that. I think we're going on our third iteration of it. So we observed over the years that the independent sponsor world is a lonely journey. And it's hard to find a sounding board. And so we have the benefit now of having a growing roster of GPs. So we invite them to come to Dallas, and it's both a educational and a fun experience. So the educational piece, we typically have someone talk about the craft. It can be working with networking capital, pegs towards the end of a closing process. It could be on the front end, thinking about how do you evaluate management teams with psychological profiles. It could be an educational piece on the growth within Texas and how we can capitalize on it. And then we also pair that with a fun component. So we invite our GPs to one of the family members' homes where we'll have a dinner, have some great wine, and inevitably the sponsors break up and they end up talking with each other about their deals, what they're doing currently, some of the mistakes they made, some of the questions that they have on their mind. And that camaraderie, we think it's super beneficial. And we now actually use it to bring GPs that are thinking about inviting us into their equity stack, or GPs we're evaluating, so that they can go ask their peer group about their experience with Lang. And we think it's been super beneficial for the GPs that we've invested with, and the GPs who are thinking about having us with them as they embark on their journeys.
Have you scheduled the next one yet, Kevin?
I think we're doing it this spring.
Okay. I was very sad to miss the first one, but I was there for the second one. Thank you. It's a privilege and honor to be part of that group. And it was a fantastic event. I felt really pampered. We had all the good food and fantastic venues, but also insightful and educational. And it was just one of the most fun things, honestly, I've done on this journey, was to be part of that group of a cohort of peers, and learned so much, met so many great people, and can't wait for the next one.
Yeah, we had a good time, Nicholas, last year.
That was really, really fun. So we in fact, I borrowed a few things from you guys as we were putting together our investor day at Minds Capital, but I think we have some work to do and need some more budget before we catch up with you guys fully.
That's funny. Well, we'll make it sure that this year is a good one.
So, Kevin, 5 years in, 27 platform investments, as we said at the top. Today, what is the split between investments in GPs, sponsors that you've already invested in net new relationships for you guys? And I guess where I'm that's a leading question, because I'm wondering if you can share whether the strategy of building relationships so that, you would hope that your funnel could be filled with just existing relationships, 100% existing relationships at some point in the future. Is it trending in that direction?
Yeah, very much so. We tend to lean towards coming back and investing in a GP's next deal, one that we vetted already, because the vetting process on the GP is so time consuming to begin with. And like I said earlier in the conversation, by then we would have had a few years of shared experiences with that GP, and we know how they act, and that's invaluable to us.
Anything more you can say about what changes, if any, or what evolutions, if any, you've just seen in this space in these last 5 years? We talk a lot on this podcast about how much growth there's been in the independent sponsor world, and how, as we understand it today, it's really only a 10 or 15-year-old ecosystem. And so, having been in it so prolifically for 5 years, maybe you've observed if that's long enough to have observed changes or trends.
Yeah. I mean, so back 10 years ago, every independent sponsor looked the same. They all had the same background, worked at larger PE, had investment banking experience, had consulting experience, and then for one reason or another, they wanted to go do it for themselves. Now, that path is still there. In fact, that path has grown larger because more and more VPs and associates are deciding to leave the funded world because the partnership ranks are becoming ever so full. But we're finding GPs coming from very non-traditional backgrounds today. Operators who run P&Ls, attorneys, scientists, and just folks that have been around the landscape and have heard about this new emerging model. We find that interesting, and it just shows you how diverse and growing the sector is.
Are there generalizations you could make there that people with the traditional background perform better or worse than these ones with less conventional backgrounds, but maybe bring something special like ops experience or like some particular industry experience?
I don't think the data set has been compiled yet. It's just too early on to determine that. Now, look, as an LP, you have to find a GP that fits your aesthetic. And our aesthetic is that we like to have folks in our portfolio that have that deal-making experience or have been around that deal-making experience, have had the ability to soak it in. So that fits towards how we like to invest. But family offices all have different ways of looking at their next deal.
Kevin, you're managing a lot of active portfolio companies, and I'm sure a big pipeline of deals that you're reviewing at any given time. Can you talk to us more about, your infrastructure, as well as, if you have a CRM or a process for just managing the workload of being an investor in this space?
Yeah, so we have a very flat organization. On the direct investing side, with respect to our private debt and private equity allocations, it's just myself and a VP who manage the portfolio, both existing deals and the origination side. So what that really means is that we try to outsource many of our functions. And to the extent possible, we try to be efficient and adopt technology that allows us to do more with less. So we've invested in our CRM. We would continually try to evolve as a family office investing platform and iterate through how technology can enable us to do more and see more. One of the tenets that we always try to measure ourselves by is swing average. So swing average at a high level is how many times we make an investment divided by how many investments we've seen. And we try to create a very low swing average because we want to see and be the market, which allows us to be discerning with our investments and swing when we have conviction.
Well, what is that percentage ratio roughly?
It averages around like 1.2, 1.4%.
Which CRM do you use?
We use Deal Cloud, and then we enable it with a couple of different technology overlays.
You mentioned outsourcing functions. So by that, I take it you mean bookkeeping and tax preparation and services like that that maybe some larger institutions would have. Is there some similarity between you there and the typical independent sponsor being lean and efficient on the infra side?
Oh, very much so, right? We want to keep our FT count low. It allows us to be opportunistic and direct resources when needed, and not to invest in additional resources, and which creates the need to continue to invest capital. We want to be able to turn on and off the spigot as we see fit.
Kevin, going back to the big news of today, Nicholas's exit. So he was your first independent sponsor investment, as we've said. Have you had other exits from the portfolio, or is he also your first exit?
No, he will have the distinction as the first investment and the first private equity investment. In our portfolio, we've had a handful of debt investments, probably 6 or 7 or so now, that have matured and exited. But on the private equity side, Nicholas is the first round trip in and out in our portfolio.
First in, first out there, Nicholas. So
I'll imagine that.
So you guys have been prolific, word we keep using, but I have to believe that this is a threshold moment for you, because despite the fact that you've deployed a lot of capital in to the asset class, you maybe haven't seen much come back out. If Nicholas is your first exit, am I reading that correctly? Is this sort of a use case, if you will, or excuse me, a case study that you'll now point to as evidence of a good strategy? Or what does it mean for you to have seen your first exit is maybe a more succinct way of asking.
It's our first hide on the wall. So we're from Texas, and we're already thinking about how we're going to brand the Service Star logo and put it on a placard on our wall. So all jokes aside, we are investing for the long term, which means that we are thinking about long-term compounding of assets in the private world. But we're 5.5 years into the strategy, and having an exit is relief because it demonstrates to the family that the strategy is working. I think it takes a lot of pressure off, and we can truly think of compounding for the rest of the assets in our portfolio because we have our hide on the wall now, and we can put our heads down and think more clearly about the strategic investments that we need to make because we've shown to the family this can work.
You mentioned in the pre-call that there's an art to knowing when to stop the compounding of a performing asset. What does that art look like? When do you stop? When is the right time to sell a well-performing asset?
Well, that's hard, right? There's the financial way of looking at it. Whether the GP is showing that they are a good capital allocator. And you can see that through the financials, right? Whether there's good ROE or good ROA on a CapEx investment. But there's an art to it as well. whether or not the value creation plan that you set forth on and enacting in year one, whether or not those items have been checked off. And really, the last one is alignment with the GP, whether they're still in it the same way you expect their interest to be. And those three things have to be right for us to continue to think that let's compound and continue to hold this in a portfolio.
Kevin, of those 27 platform investments, what's the split between partnered sponsors and loan sponsors? And how do you think about that?
That's a current trend or question in the market. We see a lot of GPs ask us off the bat if they're operating their GP solo, would that disqualify them from us making an investment in their deal? And many of our GPs are single man or woman shops. And we agree that it's very difficult to find a GP that can do it all. And we understand the concern that some LPs have that if a GP's attention or interest level drops off, who's there to take the ball? A lot of it's trust. A lot of it's understanding the GP where they are in their life and structuring the limited partnership agreement that recognizes the typical concerns that an LP has, and making sure that both parties feel that on the downside, they're protected. But many of our great deals have come from solo GPs. So we don't want to automatically strike that pipeline of opportunities from our deal set when we triage deals at the top of the funnel. In fact, Nicholas, Solo Man Shop, has produced a great return for us in our Service Star deal. And we wouldn't have been able to invest if we had that lens by which we invest.
Mm-hmm. And do you know roughly what the split is of your platform investments between partners and solo?
Yeah, probably 30% or more of our deals are from GPs who are solo operators.
Definitely a minority, but not a tiny one. Great, Kevin. Well, Nicholas has champagne bottles to go pop, so we are going to let you go. Thank you for joining us on the Minds Capital podcast. Having you today and doing this interview today was, well, really, I feel a bit like the third wheel here, but it was cool to be along for the ride for both of you guys. It was a special day, so congratulations to you both, and thanks very much for joining us.
Thank you. It was a pleasure.
Can I just say here, Kevin, thank you. You backed me back in 2020. It was off the heels of a deal that I've just completed that had been troubled. And I was seeking support, new capital partners for this new deal. And the people who backed me at that time, I will forever really cherish you guys. And thank you so very much for having been supportive then and such a great partner along the way. And I look forward to working with you again on many occasions, hopefully in the future as well.
On to the next one. Thank you, Will. Thank you, Nicholas.
Hope you enjoyed that interview. For more like it, subscribe to the Minds Capital podcast wherever you listen to podcasts. You can also watch us on YouTube. Also check out Minds Capital, where Nicholas and I are partners alongside Max Lummis. We invest equity in independent sponsor deals. So if you're a sponsor with a deal under LOI, please visit mindscapital.co to start a conversation. There's also an investor tab on our website with information about future fundraises. See you in the next episode.